5 things to know about 401k loans. Before you take one, borrowing from your 401k is not necessarily damaging to your retirement savings. When you pay the loan yourself back, the payments go back into your investments. And being twice taxed on interest from this kind of loan is likely to cost less than what it would cost to borrow money in another way. Anyways, there are 5 things to know about 401k loans before you take one. Your plan does not have to allow loans. Some 401k plans allow withdrawal in the form of a 401k loan, some do not. You must check with your 401k plan administrator or investment company. You can find their contact information on your statement to find out if your plan allows you to borrow against your account balance. Some companies will allow multiple loans, some allow none. When your employer set up the 401k plan, they decided whether the plan would allow loans or not. There is a maximum loan amount set by law. If your 401k plan does allow loans, the law states that the maximum amount you can borrow will be $50,000 or 50% of your vested account balance, whichever is less. Your vested account balance is the amount that belongs to you. For example, you may have to stay with your employer for a set amount of time before the employer contributions belong to you. The employer may require a minimum loan amount of $1,000. You cannot borrow from an old 401k plan. If you are no longer working for the company where your 401k plan resides, you may not take a 401k loan. You may transfer a balance at a former employer to a new 401k plan, and if your current employer plan allows for loans, then you can borrow from there. If you transferred your old 401k to an IRA, you cannot borrow from IRAs. It is best to know all the rules before you cash out or transfer an old 401k plan. You will pay yourself interest. The interest rate on your 401k loan is determined by the rules in your 401k plan. The interest rate is typically set up as a formula, such as prime plus 1%. You pay the interest back into your own 401k account balance. Despite this, most of the time taking a 401k loan hurts your future retirement savings. Loan is repaid through payroll deduction. 401k loan repayments are set up through automatic deductions from your paycheck. The longest repayment term allowed is 5 years. Most repayment plans are structured as monthly payments. Some 401k plans do not allow you to contribute to the plan while you are making loan repayments. One thing to watch out for: if you lose your job while you have an outstanding 401k loan, you may need to repay the balance quickly, or risk having it be categorized as an early distribution.